So, okay, now we are done with exercise number 7. Let's move to the next one, exercise number 8. While for the 7th exercise, uh, we have been more interested on survival revenues, on break-even points. For the current one, exercise number 8, we will put more stress on the concept or the issue of the cash flow statement, as well as the cash burn or the cash build for the firm. So let's do it. Now let's move to the exercise number 8. So we will open a new sheet and we call it exercise 8. I will zoom in. So number 8, the exercise deals about statement of cash flows and cash burn or cash build. So Salsa Technology Corporation increased its sales from $375,000 in 2009 to $450,000 in 2010, as shown in the firm's income statements. Here is the income statement presented below. Leanne Sands, which is the CEO and founder of the firm, expressed concern that the cash account and the firm's marketable securities declined substantially between the 2 years. So Salsa's complete balance sheet are also shown right here. So here we have the balance sheets. Mrs. Sands is seeking your assistance in the preparation of a statement of cash flows for Salsa Technology. So the first task is to prepare a statement of cash flows for 2010 for Salsa Technology Corporation. So let's start. So as you know, the cash flow statement is composed by 3 panels. The panel A is for cash flows from operating activities, while for panel B we have the cash flows from the investing activities, and for panel C we have the cash flows from financing activities. So let's start by the first one. So it is task A. So we will build the cash flow statement for the company for the year 2010. So we will start by the panel A, dedicated to the cash flows from the operating activities. So now we have to gather all the information from both the income statement and the balance sheet that are related to the operating activities, right? So we have to pay attention to not incorporate in this panel A any item that is related to the financial activities of the firm or the investing activity of the firm. So for the first item, we begin by the net income of the firm. Then we should adjust this net income by taking into account all the variation related to the cash flows. So we'll see it later how we should proceed. So this is for the year 2010. So we start by the net income. So the net income for 2010 is equal to $20,000, right? So 20. Then the next step is to adjust this net income by adding back the depreciation, because depreciation, as we have seen in the previous exercise, it is a fake or a virtual expense. It's not a real expense. It's not a real cash flow. So we should add it back. So plus depreciation. So the depreciation for 2010, see here, depreciation is equal to $30,000. So since, see, we have subtracted this amount, so we should now adjust the the net income by adding back this depreciation, because from the point of view of the finance, we should not consider depreciation as a real expense. So now, as if we are correcting the mistake made by the accounting, so we have to add back 30,000. Now we should observe the receivables, or the change in the receivables between the 2 years 2009 and 2010. Every increase in the receivables, see here, the receivables, is considered as a source, is considered as a lack of cash. So there is an opposite relationship between the receivables and the cash. Every time the receivables will go up, the cash will go down. So let's see. So between 2009 and 10, we have an increase in the receivables. See, the receivables, moved from 50 to 80. So we have an increase of $30,000. So we should subtract this increase. So less the increase in receivables. This increase is equal to, see, 80 minus 50. 80 minus 50. And since we have less here, so we should add the minus sign. So minus 30. Now the same thing is, is for inventories. See, so if the inventories will go up, this means that the cash flow of the firm will go down. So we should just check if the variation is a positive or negative variation. So the inventories moved from 151 to 2009 to 204 for 2010, which means that for the inventories we observe also an increase, which means that we will have less cash, so less increase in inventories. So equal minus the variation, which is 204 minus 151. Now let's move to the short liabilities, or the current liabilities. So start by the accounts payable. Now for the current liabilities, we will observe the inverse process, which means that every time there is an increase in the the current liabilities, this means that we will have more cash, right? So we have a positive association between the current liabilities and the cash, which means that they will move in the same way. If current liabilities will go up, cash will go up. If current liabilities will go down, so it is for the cash, right? While there is an inverse relationship between the current assets and the cash. So the accounts payable here, we have an increase, which means that the cash will go up. So plus the increase in accounts payable. And accounts payable, so equal. So see, we don't use the minus sign anymore because it is an increase. So minus 45 minus 30. 45 minus 30. Now we should skip the bank loan because the bank loan is not related to the operating activities, it is related to the financial one. So we'll see it later. in the panel C. Now the accrued liabilities, same thing, they are increasing, moving up from 10 to 23. So plus, plus the increase in liabilities. So equal 23 minus 10, 23 minus 10. Now we can sum up all these numbers to get the net cash flow from operating activities. So the net cash flow from operating activities, it will be equal to the net income plus the sum of all the below items. So 20 plus 30, sorry, this one. So minus 5. So let me check. Sorry, for the net income, sorry, net income is $70,000, right? Not 20. 20 is for the cash dividends. So this is for the dividends paid by the firm. So I made a mistake. So this is 70 instead of 20, 70. So this is the net cash flow from operating activities. This means that the operating activities of the firm is generating cash, which is a good thing. Now let's move to the panel B. Panel B, which is about the cash flows from investing activities. Now we should check the the fixed assets item in the balance sheet. So this is fixed. See, have the fixed assets. So if there is an increase in the gross fixed assets, this means that the firm is spending money to invest more in the activities, right? While if the gross fixed assets is constant, this means that the firm is not investing more money in in fixed assets. And if it is if we have a negative variation for gross fixed assets, this means that the firm is selling fixed assets. So for this example, see the gross fixed assets is moving from 200 to 290, which means that the firm is investing, and it is very logical because the firm is it is a startup and it is a growing firm. So the management will have to invest more in order to sell more. So we have here, so since we have an increase in in gross fixed assets, this means that we are spending more money, which means that we will have less cash flow. So less the increase in gross fixed assets. So equal, since it is less, so we have to put the minus sign, minus the variation of the gross fixed assets, 290 minus 200, so minus 90. So the net cash flow from investing activities, since we don't have any other item, will be equal to the increase in the less the increase in gross fixed assets, which means equal to minus 90. Now the panel C is for the cash flows from financing activities. So let's check the balance sheet. So we have here the bank loan, which is short-term financing tool for the firm. So for the bank loan, it has rise from 20 to 27, which means that we are receiving more money from the bank loan, which is a good thing for the cash flows. So plus the increase in bank loan. So this increase is equal to the variation between 2010 and 2009. Here we are, 27 minus 20. 27 minus 20. Now, another tool of financing for the firm is the common stock and the long-term debt. So for the long-term debt, there is no variation. While for the common stock, we have increased the common stock, which means that the firm or the founder, for example, might added extra funds to the firm. So this is a good thing for the cash, which means that we are receiving more cash by increasing our common stock. So plus the increase in common stock equal to the variation, which means this is the common stock, 120 minus 85. 120 minus 85. Then we have to pay attention also to the, to the dividend. Here we are. So we see here that the firm is paying dividend, and it's paying $20,000 for 2010. So this payment of dividends will decrease the cash. So less dividend payment. Dividends payment and minus 20. Then we compute the net cash flows from financing activities. Financing activities. So equal to the sum of the above three items, $22,000. And finally, we can compute the total net cash flows from all activities. Which is the sum of the net cash flows from the operating activities, the investing activities, operating activities, investing activities, and financing activities. So see, we have a minus sign, which means that the firm is, consuming more cash than it is producing. So this is the total net cash flow. Then we have to consider the cash flows at the beginning of the year. We mean 2010. So the cash flow at the beginning of the year, we should go to the balance sheet. At the beginning of the year 2010, it is the same cash flow at the end of the year 2009. So it is $39,000. So $39,000. So this is the cash or total net cash flows from all the activities during 2009. This is the cash flow available at the firm at the beginning of the year, which means that the cash flow at the end of the year will be the cash flow at the beginning plus the total net cash flow during all the year. So equal this one plus this one, $16,000. So we can check if our answers are right or not by cross-checking this number with the balance sheet statement. So we should have the same number here, see? So this is the cash flow by the end of 2012. This is the cash flow that we have found, through the cash flow statement. So if you are doing well, if your answer is good, you should find, or you must find, the same number. So this for the task A, and this is for the cash flow statement. Now the task B, provide a brief description of what happened in terms of cash flows, both inflows and outflows for Salsa between 2009 and 2010. So what he's asking for this question is to interpret the results found in the cash flow statement. So task B, actually we have to develop the results that we have found here. So how did we reach this number of this cash by the end of the year? So we have different steps. So first we have the net cash flows from operating activities. Then we have the net cash flow from investing activities. And from finance activities. So this means that, see, the main source of cash flow consumption is the investing one. And this is understandable because the firm is in the phase of growth, rapid growth, right? So the managers need more investment so they can increase their stake of the market. But the thing is, by doing so, you are pushing too hard on the cash flow that you are generating from the operating activities, from the sales. See, so your sales are not high enough to cover your needs of investment. So by seeking more, more growth, you are pressing too much your operating activities, and this can be harmful for you as a startup firm or as a venture, because by doing so, see, you need $90,000 to increase your investments, right? But your activities generate just the half of this amount, which is $45,000. So you need to raise more funds, which is $22,000, by increasing your common stock, by increasing or by asking for more loans from your bank, right? And this is not enough. So you have to take money from your available cash flow at the beginning of the year. And that's why you have just $16,000 by the end of the year. And if you continue in that way, by the mid of 2011, you will be short, you will be out of cash. You will have no cash in your firm. And this is a very dangerous situation for a startup, because as we have seen, at the start of or at the beginning of this course, for ventures or for startups, the most important thing, maybe more important than the profitability itself, is the cash flow or the liquidity. So see, so we need, here we need an extra cash from the cash flow available at the beginning of the year. So this extra cash is equal to 39 minus 16, $23,000. So we are consuming $23,000. See, so if we add the positive cash flow from operating activities, the positive cash flow from financing activities, the cash flow that we have consumed from the available cash at the beginning of the year, if we add these three cells, see, we should cover our needs and investments. So let's check it. So this one plus this one plus, this one, C90. So in order to cover our investment needs, we are consuming all the cash flow from operating activities, plus we are asking for external funds from banks and from shareholders, plus we are consuming from the available cash flow that we have built in 2009. So this is the interpretation for the results for task B. Now let's get back to exercise. Task C, use your calculations from part A for cash flows from operating and investing activities to indicate the extent to which Salsa was building or burning cash in 2010. So task C, in order to know if a firm is building or burning cash, you have simply to add the net cash flow from operating activities to the net cash flow from investing activities, and that's it. So this means the build or the burn, the net build or the net burn of cash should be equal to the net cash flows from operating activities plus the net cash flow from, investing activities. So the first one is equal to 45, while the second one is equal to minus 90. So minus $45,000, which means that we are burning cash. We have net burn cash. This is a net burn cash, for the firm. So for task C. Now, the last task for the exercise, task D. Convert the 2010 annual cash build or cash burn to a monthly rate. So this is for the net burn cash for the whole year 2010. So in order to have the net monthly burn rate, we should just divide the annual burn cash by 12, which is the number of months. So as if we are burning $3,000.71 every month. So we are decreasing our cash by this amount every month. Now, how long it will be before Salsa runs out of cash if Salsa is burning cash, which is the case here, or the expected 2011 year-end cash account balance if Salsa is building cash. So in this case, we are burning cash. So now we want to know for how long, for how long the final or the cash flow at the end of the year 2010 will allow us to continue to spend money before we run out of cash, because by the end of the year we have $16,000 in the firm as cash, right? But we continue to spend $3,750 every month. This means that the amount available by at the beginning of the year will not be sufficient to cover all the next year. So time before the firm runs out of cash, so you have just to divide, the cash available at the beginning of the year 2011 or the end of the year 2010 by the consumption, or how much we are burning cash every month. So we should pay attention to to eliminate the minus sign, so to avoid to have a negative number, because here we are talking about time. So the available cash by the end of the year 2010 will be sufficient enough to cover our the cash expenses for just 4 months and 0.26, which means almost, more or less 1 week. So by the first week of the month of May of the year 2011, we will be out of cash, right? Now suppose that the firm is, building cash instead of, of burning cash. So this means that we have net monthly build cash rate. So since it is a build cash rate, so it is a positive, or we'll have a positive sign, 3.75. Now we no longer will talk about time before the firm runs out of cash, because we will not run out of cash. We will not, we will not run out of cash because we are adding more cash every month. So we will put here the available cash, available cash at the end of the next year, which is 2011. So it will be equal to the available cash by the end of the year 2010, plus the monthly billed cash rate times 12. So this means that by the end of the next year, if we continue to build cash at the same speed, we will have by the end of the year $61,000. So that's it for the exercise number 8. So that's all for today. I hope you will find this video helpful and useful in preparing your exam. And please do not hesitate to contact me should you need any further explanation, or should you have any question. Please don't hesitate. So I hope you good luck for your exams, and see you next time, inshallah. Bye bye.